Ladies and gentlemen, good day and welcome to the Sapphire Foods Q4 and full year FY25 earnings conference call hosted by Vogabe Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjay from Sapphire Foods. Thank you and over to you, sir.
Welcome to Sapphire Foods Q4 and financial year 25 consolidated financial highlights. I am joined by my colleague Vijay Jain, who is our CFO. First, a quick briefing on the full year performance highlights. In what was a difficult year, we still delivered double-digit restaurant count and restaurant growth. Number of restaurants grew at 10%. We added 91 restaurants during the year to close at 963 restaurants. Our sales grew at 11%. Adjusted EBITDA grew or declined by 4% in the entire year. KFC for the full year was at -4% SSSG, and with -4% SSSG, we opened with our store openings, we delivered a double-digit revenue growth of 11%. And despite the negative SSSG and the operating deleverage as a result, our EBITDA margins were healthy at 17.3%. And we crossed a significant milestone of 500 restaurants during the year, thereby doubling our count over 3 years. Pizza Hut had very good 3 quarters from April to December, and then we slid back in the 4th quarter, which we'll talk about a little later. We ended the year at -1% SSSG. In the quarter, we were +1 SSSG. Sri Lanka had a very strong turnaround in the full year. We grew revenue in LKR terms by 14%, and restaurant EBITDA margins were healthy at 15.4%, first time in 3 years that we've been able to clock above 15% restaurant EBITDA. We were rated the #1 QSR in India for the 2nd consecutive year on the Dow Jones Sustainability Index. It's a big achievement for the organization. And then in the recent Yum Global Franchisee Convention, we were recognized as the world's top 4 Pizza Hut franchisee. Among thousands of franchisees, we were rated as world's top 4 Pizza Hut franchisee. The world's best Pizza Hut franchisee for people practices. And finally, the big award was of the world's best KFC franchisee. So these awards mean a lot. As I said many years ago, we aspired to be India's best restaurant operator. Certainly, we are among the top 1-2 best global Yum franchisees, certainly. Quickly, the Q4 highlights. We delivered a revenue of 710 crores, 13% growth, led by KFC India and Pizza Hut Sri Lanka. We added 6 KFC restaurants and took our total count to 963 as of 31st March 2005 also. Consolidated restaurant EBITDA decreased 1% year-on-year and margin was at 12%. Adjusted EBITDA of 50.8 crores was a 7% decline year-on-year, and our adjusted EBITDA margin was 7.2%. Consolidated EBITDA was 16% or 113 crores and increased year-on-year by 3%. Consolidated PAT was 2 crores or 0.3%. Adjusted PAT was 3.3 crores or 0.5%. Let me now take you to the KFC slide. in quarter 4, our SSSG trajectory was continued to improve upon versus the previous 2 quarters. However, on a base of last year where we had declined in terms of SSSG, our delivery mix continued to increase vis-a-vis dine-in and takeaway, and our big campaign for the quarter was to focus on what we call new consumers of KFC, and it centered around our Epic Core variety campaign, with also value around our core offerings being called out. This is the going forward focus of the brand. How do we represent our core variety to consumers with value? Chicken bucket, zinger burger, boneless chicken and roll. And apart from this, the other positive of the quarter was our own delivery business. After 2 or 3 years of being stable or slight decline, actually improved and had the greater SSSG uplift in this quarter versus even the aggregator channel. It's still small part of our business. The drop in ADS that you see from a quarter-to-quarter basis really reflects new store and some amount of seasonal movement from quarter 3 to quarter 4. The brand priorities are quite clear. This is the slide number 21, and this is something that I've spoken about earlier. We've launched a premium burger called KFC Gold. Apart from being the premium burger, it has also been launched in our popcorn and in our boneless range. So it's really a lot of sauces and a lot of dips that are very popular with the younger generation. On slide number 23, you can see our emphasis on boneless that we are trying to drive. Digital kiosks continue to be rolled out. Now it's implemented in about 238 restaurants. Over to Vijay for the financial numbers.
I'm on slide number 26, which presents channel-wise sales contribution. Dining plus takeaway came at 57%, and the delivery was at 43%. Sanjay mentioned about our own delivery growth. Our own platform growth was 3x the growth which we experienced on aggregator platform. So that was a big positive for us. In terms of SSSG, the trend continued to improve. We were at -1%, and overall revenue grew by 12% on back of 73 restaurant additions which we had in last 1 year. Gross margin dropped marginally. However, restaurant EBITDA dropped to 15.7%. This was a result of operating deleverage, lower ADS which we experienced in Q4 compared to Q3, and a higher delivery mix. Slide number 29 shows 4-year trend. Clearly seen that despite 2 challenging years now, back-to-back 2 challenging years in terms of SSSG, brand has still delivered a healthy EBITDA of 17.3% in the last financial year.
Let me now take you through Pizza Hut, and I'm referring to slide number 31 in our deck. Our 6 pillars of the Pizza Hut strategy continue as articulated earlier to drive taste superiority through pizza and sides innovation, differentiated dine-in experience like casual dine-in restaurants, and a hot and fresh delivery experience. We should offer competitive value for money, mass media advertising to drive consumer awareness and consideration, and be cautious in terms of store expansion. So this strategy actually resulted in improved performance in the 9 months between April and December 24, when our ADS moved from 41,000 to 48,000. However, starting JFM quarter 4, we have not been able to invest in mass media advertising, and that's resulted in an impact on our transactions, and that's really arising out of a difference of view between two franchisees, between us and our sister franchisee, with respect to marketing strategy and the additional investment that we have been doing from April to December behind mass media advertising. Now, while Yum is aligned with investing similar to us, the difference in opinion has meant that we have not been able to advertise in markets which are common markets, and that so we still spent money, but we spent money below the line, and that below the line advertising was not as effective. We believe that this difference we should be able to resolve in the next couple of months. Having said that, one of the pillars of our strategy was a continuous innovation pipeline. In accordance with that strategic pillar, we've had a really exciting refresh of our core pizzas, which is the Juicylicious pizza that we launched in April 25. Now, while we are not able to do mass media advertising in parts of our market which are common markets between us and our sister franchise, at least in Tamil Nadu, which is a Sapphire exclusive market, we'll be going behind mass media advertising, and then we'll spend money on below the line in other markets. And clearly, we see that Tamil Nadu is driving differential performance versus the rest of the market because consumers are being aware of this range before they come, and that's pushing them to come to our stores, and that's driving them, that's driving transactions. Whereas in other markets, without the help of mass media advertising, we're not able to address new consumers and not able to tell them about this innovation. Like I said, we expect this to get resolved in a couple of quarters, and we'll see it play out. You can see the pictures of Juicylicious pizza on slide number 33. We'll get Vijay to talk about the financial numbers.
Slide number 36, channel-wise sales contribution. So dining in takeaway mix at 48%, and delivery at 52%, in line with the previous quarters. In terms of SSSG, positive SSSG of 1% for the quarter. However, the ADS dropped to 42,000 and overall revenue grew by 5%. Gross margin dropped by 70 basis points, and on back of the increased value and promotional offerings. This combined with low ADS and increased marketing spends, although below the line, but we continue to spend behind additional marketing as well, meant that the restaurant EBITDA was impacted, which came in at 4.6% negative. Slide number 39 gives 4-year trend. The gains made in the first 9 months of the last financial year, where we were able to clock 48,000 ADS and hit 5% profitability, clearly has been eroded in Q4 due to pull-out of mass media campaign. And as mentioned by Sanjay, we'll need a slightly longer horizon on the brand. And once we're able to resolve this in the next couple of quarters, we're sure we'll be again back on the path of recovery for the brand.
Quick update on Sri Lanka. Q4 has capped a year of a very impressive turnaround for this Sri Lanka business. We have grown SSSG and TG double digit, and restaurant EBITDA has crossed 15% after 2 years of coming well below 15%. From a new launches perspective, we continue to support Melts, has come out in a singles form. We've introduced some really good fries. We opened 1 store in Endaramulla, and for the numbers, over to Vijay.
Slide number 43, dining and takeaway mix at 62%, similar to previous 2 quarters. The SSSG was 16%, backed by a double-digit transaction growth. Overall revenue grew by 19% in LKR terms and 31% in INR terms. Gross margin dropped, however, restaurant EBITDA improved by 250 basis points year-on-year and came in at 14.8%. Slide number 47, which gives a 4-year trend, clearly seen the business has made a strong comeback and has delivered the highest restaurant EBITDA margin in the last 3 years at 15.4%.
Yeah, that's the update for the quarter. It's been a difficult quarter, especially on Pizza Hut, but we expect that, we believe that the strategy still is the right strategy to pursue, and we will sort the differences in opinion that we have. The good part is that Yum is aligned on what we plan to do, and we should see an uptick in performance in the coming months stroke quarters. I'll stop here now and open this to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
We can start, Harshad, with Vidisha from Ambit Capital.
The first question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Hi, good evening team. I hope I'm audible. My first question was if you can give some color on the broader demand scenario and specifically on KFC, SSG, although the momentum of SSG has improved, it's still in the negative territory. So if you could comment on whether with a high single digit decline in the base, is it logical to assume that SSG would turn positive in the first half of FY26?
Yeah, so the demand situation continues to be neutral. It's not improved or it is not worsened off over the last 3 or 4 quarters. So it's still a tight demand situation, and then coupled with heightened competitive pressures has meant that growth has been difficult to come by. You are seeing minus 1% SSSG in quarter 4 on the back of, I think, again, very low single digits the previous year. So as we move forward, certainly we'll see a more stable SSSG, but it is on the back of earlier low SSSG quarters.
Understood.
The current trend is flattish. The current trend is flattish SSSG. That's the current trend which we are experiencing.
Got it. Right, sir. The second question was on your commentary on Pizza Hut. You've talked about the longer horizon required in terms of reviving the brand. So is the visibility on even early double-digit margins deferred, given that attaining the 50,000-55,000 ADS threshold would be difficult in the medium term? Basically, how should one think of margins when it comes to Pizza Hut? Those were the 2 questions from my side. Thanks.
No, I think you got the intention right, that once we move towards 55 ADS, that's when we'll deliver double digit. We were expecting in a scenario when all of us were aligned, we would have expected this to happen between 12 and 18 months. I think perhaps that has got extended a bit.
In the immediate scenario, when I look at the coming year, I think it would still be range bound to a flattish kind of to low single digit restaurant EBITDA, which we experienced last year. Because the first step would be how do we get the movement back from that 41, 42 level. We have reached 42 level. It's the same place where we were probably a year ago. So it's the same journey we have to start again. So in the next 12 months, I don't see this EBITDA moving beyond low single digit number.
Thank you for your answers. I'll get back in the queue for follow-up.
Thank you, Vidisha.
Thank you. The next question is from the line of Gaurav Jogani from JM Financial. Please go ahead.
Thank you for the opportunity, sir. So my first question is with regards to the network addition guidance. In the current weak in the environment scenario, if you can help us, how are you looking to now alter the store addition network, both in the KFC and the Pizza Hut format?
So I think our last guidance still stands. In the previous quarter call, we said KFC we can look at opening 70 to 80 stores or anywhere between 60 to 80 stores. That guidance still stands, and that's a medium-term guidance, not just for this particular year. I think we can continue to add 60 to 80 stores. For Pizza Hut, we said our restaurant expansion strategy will be extremely cautious, and that's what we continue to follow. So we don't see additions which are, let's say, beyond 20-25 stores in a year max.
And sir, this would be the net additions or the gross additions that you would be guiding?
These are net additions.
Net additions.
Sure. And so the next question is with regards to KFC margins. You have been doing a very resilient performance when it is coming to the margins. Despite that ADS remaining where it is, still the 17.5% margin is very commendable. Now, I just wanted to take your sense, that given the environment, as you mentioned, this stays where it is right now, what kind of margins can we expect in the next 12 to 18 months going ahead?
I think holding on to the current level margins would be a good achievement, and for holding the current level margins, we will require some SSSG, even if it means low single-digit SSSG. And I think that's what our immediate task would be, to get back into positive SSSG territory. Currently, we are experiencing flattish, but as we move into a territory which is positive SSSG, holding these margins would be important. So that's what I think the near-term 12 to 18 month guidance would be.
So sir, just a follow-up here. I mean, given that I'm assuming that you would have seen your cost structures, which would have helped you to achieve these kind of margins despite a lower ADS.
Yes.
So would experiencing a better ADS then would flow through the margins and then could boost the margins slightly going ahead?
So if we start getting SSSGs of 5% and plus, then definitely we can see improvement in margins. So it's all linked to the SSSG. I said that if we are experiencing flattish and maybe even low single digit, if we are getting a low single digit, we should be able to hold margins. If we are able to get beyond 5%, 6%, we should be able to improve margins as well.
And so this last question from my end on KFC only. If you can highlight, what really is the problem that you're facing with the KFC franchise? I mean, is it the macro slowdown which is impacting the business here? Is it competition or is it something else, that is taking longer than expected for the brand to recover?
I think it's a combination of macros with a combination of also competitive intensity. So I don't think we were expecting in the coming financial year, because of tax SOPs and inflation reducing, we are expecting discretionary spends to increase. However, quarter four, there was the earlier trend continued, and that's reflected really in the SSSGs that we saw, and hence in the EBITDA margins.
Okay. So if I summarize it right, you're saying that it's a combination of slowdown and the competitive intensity, which is kind of leading to this slowdown. And you're still hopeful that these tax SOPs and inflation should the reducing inflation rather should help to drive the demand improvement going ahead.
Correctly captured.
Sure. So thank you for this.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Saurabh from Goldman Sachs. Please go ahead.
Yeah, thank you very much for the opportunity. My question is on the comment made earlier by Sanjay that you're confident that in the next 1 to 2 months, the difference of opinion in Pizza Hut will be resolved. So just wanted to ask what gives you the confidence that in the next 1 to 2 months you will resolve that difference with the sister franchise?
No, so I never said 1, 2 months. I said in the coming months, it might take 1 to 2 quarters rather than 1 to 2 months.
All right.
I guess what gives us the confidence is the fact that the difference of opinion really stems from our belief whether spending on or investing behind mass media advertising is resulting in increased transactions or not. We have certainly seen that joy, and if there are questions in someone else's mind on that is perfectly all right. I think the only way to do that is through data and through actually proving that this can work. And therefore, we continue to invest behind mass media advertising in Tamil Nadu, which is a Sapphire exclusive territory, and being able to showcase differential performance there should convince everyone that this indeed is the right strategy to adopt. And therefore, perhaps let's look at internal execution and see what can we do to actually capture additional footfall that this can offer us.
Understood. My second question is on the capex number. I'm just looking at the cash flow statement. It appears that simply on a net store addition basis, it is again close to 3 crores per store. I'm taking on net basis. Now, can that trend be expected to continue, or were there any extra investments this year other than store additions?
Again, I don't think that's the right way to look at it. And even if I look at the net stores, we would have added roughly 100 plus stores this year, including our Lanka. And if I remember the correct number correctly, I think it's 265 odd crore rupees, which is reflected in the cash flow.
Okay.
So even if you do the math on a gross basis, which is the way you are doing it, it does not touch 3 crore rupees. So let me just clarify that.
Okay.
Having said that, the number consists of multiple things, not just new store additions. It also consists of the refurbishment of old stores, which we have completed 5 years or 10 years. It also consists of tech investments as well. So there are a lot of components to it. If I come down to the breakup in terms of the new store, the KFC is still in the range of 2.1 crore rupees for KFC, and Pizza Hut is in the range of 1.35 crore for per store.
All right. Thank you very much.
Yep.
Thank you. The next question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Hi, thanks for the opportunity. Sir, a question on KFC. Q1 typically is the strongest quarter, with the rest 3 quarters having some days where the consumption is weaker. This time around, Eid was also preponed to Q4, where I am suspecting that consumption may be lower. So we have a relatively cleaner Q1 this time around versus last year. So how should we read this flat SSG? Is there actually some demand improvement happening, or it has further worsened in April so far?
So again, April we had Navratra this year. So on top of that, the flat SSSG really says that there's no material improvement or deterioration in the demand conditions. So that's all that it says. And it's really too early. May, June are in the quarter the better months. It's too early to comment on May.
Understood.
And sir, we are sustaining with this epic campaign for KFC, which was launched last quarter also.
Yeah.
So what are the key benefits that we have gained during Q4, and what are the expectations from this campaign going ahead?
So the campaign is really focusing on the variety that we offer in our core range, and through that we expect to get more consumers who are aware of the brand but not tried the brand to come into our stores. That we have identified over the medium term as the biggest opportunity on KFC, increasing consumer penetration while continuing to hold on to brand loyalists. So that is what really this campaign is aiming to do. Now, this is not going to happen in one or two campaigns and one or two quarters, and we should sustain the intensity and the thought behind this idea that we present our variety in core and offer great value on core to pull new consumers in. This is the intention. You see this continue for over a period of time.
In terms of the benefit, we have definitely seen transaction improvement. So while our SSSG was negative in H1 of last year, our transactions were also negative. And what we did experience in the last 2 quarters of last year, which is H2, that the decline in transactions was definitely lower than the decline in the overall revenue for the same stores. So definitely the focus on the value has helped us arrest the transaction decline. Now we are largely neutral on the transactions. Hopefully from here we can grow the transactions as well.
So last question from my end.
Sorry to interrupt you, sir, but I may request you to rejoin the question queue.
Sure, no issues.
Thank you. The next question is from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Thank you, sir, and congratulations for a decent set of numbers in a very tough environment. Sir, a couple of things which I wanted to understand that given the fact that Pizza Hut as a brand is changing, is seeing some challenges, are we looking to add more brands to our repertoire? And secondly, sir, when I'm seeing the percentage of delivery from dine-in, even for KFC, it's down to 30s and it's constantly declining. So is a pure takeaway or a pure cloud kitchen concept is something which you might want to think about at some point of time?
The second question pertains to Pizza Hut or KFC or both?
Well, both. Pizza Hut is at 26%, so basically our business is starting to become more and more takeaway business.
Okay, so let me just take it one by one. On multi-brand retail strategy, we have always called out that our people, tech, process investments over the years are in a way to handle multiple brands. And while we believe both KFC and Pizza Hut has a multi-decade runway, we would love to add a third brand at some point in time. However, the parameters and the benchmarks which you have laid out are quite high, so that we don't end up wasting resources and the bandwidth behind a third brand which becomes inconsequential. So the two key elements are that it has to be scalable or a scale brand which can give us success. So we are only interested in success at scale. Anything which is where either of the two stuff is missing, we will not be too keen to adopt that third brand or acquire that third brand. And to identify whether a brand can be successful at scale, we have called out 7 specific filters or 7 Sapphire mantras. I'll not go into the details right now. You can refer annual report or we can have a separate conversation. And each of those 7 parameters are key for us to ensure that we achieve success at scale. So that's the view on the third brand. On the second part, to do a takeaway or a cloud kitchen, we have always called out 2 things. First, from a brand or a customer propositions, and especially this works in case of Pizza Hut, we want to be different compared to the number 1 brand. I think that positioning of just a delivery brand is taken by somebody else. If we have to be relevant and relevant number 2 in the long run, we need to offer a point of view of difference, and hence a dining forward omni-channel strategy, I think, works best for us in the long run. And while currently we are seeing challenges on the brand, I'm sure by having a differentiated positioning, it will help us come out stronger or emerge stronger in the long run. That's first on the customer perspective. Second, from a financial perspective, even if you look at a cloud kitchen or a takeaway, we don't think the economics works clearly, because 70% of our capex goes into the back of house, which is kitchen, and your delivery takeaway component, let's say, is today 50%. Profitability in those channels are lower compared to dining profitability. So the economics doesn't work as far as we believe. So no, the answer is no. We'll continue with our dining forward omnichannel strategy on both the brands.
Okay, thanks a lot.
Thank you. The next question is from the line of Tejas Shah from Avendus Spark. Please go ahead.
Hi, thanks for the opportunity. So I just wanted to understand if you like to break down the slowdown across footfalls, conversion rates, bill cuts, and ticket size. Where are you seeing the highest pressure in terms of consumer sentiment?
Sorry, Tejas, I was not able to understand your question because the voice broke. Can you just repeat it?
Sure. No, so I was just asking if you have further double down on the slowdown or consumer sentiment. Where I'm seeing the max pressure, is it that footfalls have been compromised, conversion rates, or they are coming and they are not actually consuming more than before in terms of ticket size or bill cuts?
Footfalls more than anything else. So APC is all right, and dine-in footfalls especially have been challenging. And delivery, while it's growing, it's not really growing to the extent that it used to also.
Okay. Second, if I heard you correctly,
Sorry to interrupt you, sir, but if you're connected to your headset, then you may please switch to your handset as your voice is breaking.
Is this better?
Yes, go ahead and we'll find out.
We'll figure out, Tejas. Go ahead.
Yeah, sure. I'll give it a try. Yeah. So no, I just wanted to know, from your commentary today, do you believe that the split franchise ownership structure in India is somewhere limiting our ability to drive any targeted interventions to revive SSGs and sentiment?
So it's not ideal, but that is how it is, and we have lived with it for 7-8 years, and I think we can still deliver good outcomes even with a structure like this.
Those are relatively easier times. That's why I'm wondering now, and when times are challenging in terms of consumer sentiment across, not only for us, but other basket at large also.
Yeah. To be fair, when we took over the brand, both the brand stages, I don't think the numbers were easy then. If I remember correctly, KFC was low single digit or not low single, 7-8% restaurant EBITDA. Pizza Hut was still 5-6%. So even those were tough times. So I think we have been able to navigate quite well through the situation, and we are confident that even right now we are hopeful of solution, and we will be able to navigate through the situation as well.
And it's all right. We found great joy in this strategy. Someone else might have found little less joy. I think the only way fundamentally there is no major misalignment. It is how one wants to spend money. We believe that this still is the best way to go forward, and as we continue to spend in our exclusive market, this will play out over the next couple of months.
Next couple of quarters.
Perfect. And if I may squeeze in one more regarding
to interrupt you, sir, but I may request you to rejoin the question queue for follow-up questions.
Thanks.
Thank you. The next question is from the line of Aditya from JP Morgan. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question is on the delivery channel for KFC. It was good to hear that your own channel grew much faster than the 3P aggregators. It would be great if you could highlight what will be the contribution of your own channel to either the overall revenue of KFC or to the delivery revenue? And as an extension to the last question as well, how do you think about scaling up the own delivery channel, and is there any misalignment in that strategy versus either Yum India or versus your sister franchise? Thanks.
So the contribution of our own channel is still small. It's closer to now double digit 10%, I would say, for KFC. And I think that's a similar number for Pizza Hut as well. That's the first part of your question. The second part, I was not very clear on the query. You were talking about whether there is any misalignment on the own channel delivery strategy between us and anybody else. That's what you were referring to?
Yeah. How, do you want to scale it up aggressively? How important is this for you?
So own channel has always been a very important focus for us over the years. While the results wouldn't have been there, because no matter whatever we do, I think the aggregator channel grew considerably faster compared to us. And during those times, our own channel also performed very well. But yes, the aggregator channel performed much better, and especially, of course, with the kind of money and the horizontal play, sometimes could be a tough one to beat. But it has always been an area of focus. We have been always investing behind the app, as well as a lot of product or promotional offers are sometimes unique to our own app. So those measures have always been there previously, and will continue to work on the similar means going forward as well.
Thanks. My second question is a bookkeeping question on the depreciation charge. It was lower sequentially and year-on-year this quarter. Is it because of accelerated depreciation because you had some store closures for Pizza Hut? And do we expect it to revert to the Q3 run rate in the next quarter?
So the depreciation charge was lower, right? That charge was lower because we had reversals on some of the... this is now post-Ind AS accounting. Could be difficult probably to understand over a call. I'll try it. So when you do a post-Ind AS accounting, you basically book higher amount during the initial period of lease under depreciation and the finance cost. And if there are store closures or you have taken a provision for store closures, those provisions get reversed. So what we have seen is benefit of some reversals coming in this particular quarter. So you are right, we will go back to the earlier quarter trend. You are right, we will go back to the earlier quarter trends.
Thanks, that was very clear. I have a few more questions, but I'll come back in the queue. Thanks.
Yep.
Thank you. The next question is from the line of Subrata Sarkar from Mount Intra Finance. Please go ahead. Mr. Subrata, please go ahead.
Hello.
Yes, sir. Go ahead.
Yeah. So my question is more so from an industry perspective, since we have observed the emergence or development of this industry in other Western countries. So particularly these Western QSR, what is our observation? Its consumption generally goes up at what rate to that of a, let's say, premiumization or increasing the per capita income? So is there any study when it moved to, let's say, 2,500 to 5,000 per capita bracket, what is the elasticity of QSR generally to that of the income?
I'll try and answer the question to the best of our understanding. So $2,500 to, when it moves towards $3,000 per capita income, that's the time when we see exponential growth in the QSR industry. That's what we observed across the various economies. And that's one parameter which is on per capita income. Especially in case of KFC, there's another angle which is the protein consumption increase. And we have seen that, especially in Asian economies, where chicken is a preferred source of protein compared to Western economies where beef is more preferred. That's another angle which is a headwind, or not headwind, tailwind, which actually helps us as the per capita income grows. The protein consumption also grows. And for a QSR which operates in a chicken segment, KFC, this is another area which helps grow the number of restaurant count and the brands faster. So these are the two angles which we have seen in some of the Asian economies especially.
Okay. And sir, again, your thought on that. Let's say the way we derive this kind of analysis, like, do you think that the bucket which we have observed, let's say in developing country, like the discretionary consumption bucket, and right now the discretionary consumption bucket which India will experience, is there a change in that? Like whether QSR, like the way it was at that point of time, the discretionary consumption, out of that QSR used to get one of the primary consumption was QSR, increase in QSR. Is it still relevant in today's context, sir? If I think I'm clear with my question.
Not too clear. I'll still give it a shot. Discretionary income is always the component which we are industry like ours is dependent on, and as the per capita income goes, that's the bucket of the consumer which grows faster, and that's where we tend to benefit and grow faster along with it.
Let me reframe my question, maybe it will help you. What I mean to say, like, let's say 20 years back or 25 years back when US, let's say 30 years back, when US observed the increase in discretionary, the increase in per capita income, and because of that lead to a higher discretionary expenditure, and QSR get one of the prime share of that. What my only question is, like, assumption holds, if that assumption holds good with the increase in per capita income, discretionary expenditure will go up. But my only point to understand from you, like the way QSR was relevant in terms as a one of the component of discretionary expenditure, does it still hold good in terms of share of discretionary consumption, QSR expenditure, or there are other expenditure which will now become more relevant in the bucket of discretionary consumption, and that's why QSR growth may get hampered?
I don't think we have done such detailed analysis of one category versus another category. I'm saying in general, when we observe the correlation of per capita income and eating out occasions, you find, as Vijay was saying, that once you go above a certain threshold, there is exponential growth that starts to happen. I think we should just leave it at that for the moment.
Subrata, maybe we can connect offline again if you, so that we can understand your query better as well.
Okay, sir. No issue, sir. No issue.
Okay. Thank you so much, Subrata.
Okay.
Thank you. The next question is from the line of Saurav Kundan from Goldman Sachs. Please go ahead.
Thank you for the opportunity to ask a question again. I just wanted to double check that we have generated positive free cash this year, right? If I'm not mistaken.
Yes.
Okay. And and this should continue, I believe, because margins, let's say even at the low single SSSG margins, you said will be more or less stable, and your capex requirements are only coming down because you're adding fewer stores than last year. So free cash generation should continue into the next year at least also, right?
So current year we generated, so our capex and our EBITDA was largely similar this year.
Yeah.
Again, this was a year where we opened, from a financial year perspective, we opened 70 stores only for KFC, and Pizza Hut was 15 stores only. Apart from that, there were a couple of other components. For example, we had a loan which was made to our Sri Lanka subsidiary during tough times when they were facing macroeconomic crisis and there were dollar shortage. So there was a repayment of that loan which came in. That's roughly 25 odd crore rupees. We were able to generate huge positive on a working capital cycle as well, and that gave us a 30 odd crore rupees. So there were a couple of other factors as well. But yes, we don't anticipate our cash flow vis-a-vis our EBITDA to be, I would not say neutral next year, but yes, we may have to dip into small amount of our cash reserves.
Okay, you might have to dip into some cash reserve next year?
Because apart from, let's say, there could be renewal fees which are coming off. As a Sapphire Foods, we would be now completing 10 years since our acquisition of the store. So there would be a renewal fees which would be coming up for YUM payment coming year. And apart from new stores, there are always agenda on refurbs. And typically when you try and complete, when you complete 10 years, there are a lot of refurbs which are on major side, major refurbs rather than minor. So we don't expect the cash flow to be positive coming year. We expect we'll marginally dip into our resources of cash.
Okay. May I know about the renewal?
Sorry to interrupt you, sir, but I may request you to rejoin the question queue for follow-up questions. The next question is from the line of Ashutosh Prashar from Mirabels. Please go ahead.
Hi. Thanks for the opportunity. Just a couple of questions. Firstly, on the Sri Lanka, that now that the SSG turnaround has sustained over the last few quarters, what do we see in terms of store additions? Do we have the opportunity to accelerate from high single digits to maybe early double digits over the next couple of years? So any outlook on that? And QOQ, we saw a bit of moderation in both Pizza Hut India as well as Sri Lanka in the gross margin. So any comments on that? And secondly, on the corporate cost side, we have shown remarkable constraint. Like last 2 years, we have grown only by single digits. So should we expect that victory to continue? Those will be 2 questions. Thanks.
I'll try and remember all the 3 questions. So the first was on the Sri Lanka store additions, which was, I think, yes, now that it's more stable. Earlier we were looking at a low single digit restaurant addition. I think now we can look at high single digit restaurant addition, at least in the coming year and maybe next 2 years as well. That's on the Sri Lanka store addition. On a gross margin perspective, you refer to both Sri Lanka as well as Pizza Hut India. I think our focus on driving value and our promotions are also tailored accordingly, and that's what has led to the decline in the gross margin for both the brands. Sri Lanka, we have been able to see the joy which has come along with it, which is double-digit SSSG backed by transaction growth. Hence, despite the dip in the gross margins, we were able to deliver a 250 basis points improvement in restaurant EBITDA. Unfortunately, while gross margins dropped in India for Pizza Hut, we were not able to see SSSG, and that has led to a deterioration in our restaurant EBITDA. We believe the current level of gross margins are stable level, and we don't anticipate this either going upward or going downward materially. There was a third question, which was, I guess that I missed the third one.
On the corporate cost side.
On the corporate cost. Yeah, so corporate cost was single digit. Typically, the kind of thumb rule which we use is, can the corporate cost grow at a 2/3 to 3/4 of the overall revenue growth? Our revenue growth last year was at a console level 13-14%. And yes, a single digit growth was a good outcome. I would say if the brand, and we don't target to grow revenue at low single digit or a low double digit, we typically target whether revenue can grow towards 15-20%. And our typical target would be then to grow, the corporate cost would grow at double digit. Let's hope this year we don't see a situation where the revenue grows in low single digit or low double digit.
Got it. If I may follow up on the value offerings. So on the Pizza Hut side,
Sorry
while
to
it is evident
interrupt
that the
you,
gross margin.
but I may request you to rejoin the question queue for follow-up questions.
Sure.
Thank you. The next question is from the line of Aditya from JP Morgan. Please go ahead.
Hi, thanks again for the opportunity. My question is on any regional or state-wise, city-wise divergence you are seeing in terms of SSG, and in the coming financial year, do you expect to shift your store expansion in any meaningful way in terms of city tiers or regions or states versus, say, what you did in FY25? Thanks.
So we are not seeing too much variance between various cities and state in terms of the SSSG performance. Yes, in case of Pizza Hut, we are investing, as Tamil Nadu is an exclusive territory. We said we will invest there heavily on our mass media and through a mass media campaign as well. There, and it's very initial days, we are seeing slightly differential performance in terms of SSSG for our Tamil Nadu territory. But again, as I said, initial days. On coming to store expansion, 70% of our stores, which we added even in the last 2 years, are in metro and tier 1 cities. I think that ratio and mix will continue even going forward, at least for the next 2 years.
Thank you.
Thank you.
Thank you. We will take that as the last question. I would now like to hand the conference over to the management for closing comments.
There's one person, Ashutosh Parashar.
We can take that one
We
question.
can take that one question, Amshad.
So the next question is from the line of Ashutosh Parashar from Mirabills. Please go ahead.
Yeah. Thanks for the follow-up. Just a question on the value offering. So while the impact on gross margin of the value offerings is visible in Pizza Hut, the same is not there in the KFC. We have held up the gross margins there very well. So any comments on that?
Actually, when you look at quarter-on-quarter, there we would have dropped very small amount of gross margin over there in case of KFC. Also, there are always an opportunity where on few product compositions or can we do some tweaking so that we can hold on to gross margin. So some of the value offering impact has been negated by small tweaks here and there in terms of our product composition. But there is certainly a drop even in KFC when you compare Q4 versus Q3.
Got it. Thanks a lot for the follow-up. Thanks.
Thank you.
Thank you very much. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Yeah, thank you everybody for joining our conference and being patient with your questions. We will see you in 3 months' time to announce our first quarter results. So thank you very much.
Thank you. On behalf of Sapphire Foods, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.